The first balance day adjustment we need to make for revenue is a prepaid revenue. That's where we've received revenue but not yet earned it. So for example, customers have paid an airline $90,000 for flights in October. Our airline will eventually earn that revenue by flying the customer to their destination. Let's say on balance day, which is the end of October, there's still $10,000 of flights that haven't been provided yet. These are for customers who booked their flight for November. They paid in October, but they're not going to take their flight until November. So what we say is on balance day, we've got two kind of parts to this. There's the revenue that's been earned, that'll be the $80,000. And why is that a revenue? Because there's been an inflow of economic benefits. There's $80,000 of being earned here. There's an increase in assets, the cash account, and there's going to be a subsequent increase in owner's equity. Then we've got to worry about this $10,000 in November. So we've received that money, but we haven't earned it yet. So we're going to call that a liability. And the reason is there's a present obligation, and that's to provide $10,000 worth of flights in the future. There was a past event, which will be the customers who paid us in October. And there'll be an outflow of economic benefits in the future, which will be all the resources required to provide the flight. So the fuel, the paying the staff on the plane, and the food on the plane, and so on. They're all resources that are going to be leaving the business in the future to earn this revenue. So if we were to do our financial reports at the end of October, we've got the revenue that's been earned. So in our income statement, we have revenue, airfare sales, $80,000. But we'd also need to include this liability for the unearned part, and we put that in the balance sheet as a current liability, and we'd call that prepaid airfares revenue.